Okay, now the expense recognition principle, which is the basis for recording the expenses. So expenses are the cost of assets used up and of the liabilities created in earning the revenue. So expenses have no future benefit of the company. So recognition of the expense principle includes two steps. First, identify all the expenses incurred during the accounting period. Measure the expenses and recognize them in the same period in which any related revenues are earned. So what does it mean? It means to recognize expenses along with related revenues, which means to subtract expenses from the revenues to compare net income or net loss. Right? For example, if you want to find out how well performed this business during this accounting period, for period of 1st of Jan to 31st, you just from revenue you minus the expenses, you find out the net income or net loss, right? That's what we mean by related revenues are earned. And one thing to remember, that these expenses should be related to the revenues, right? And within this time period. So here come the exhibit 3.2, which illustrate the expense recognition, sometimes referred to as matching principle. So some expenses are paid in cash, other expenses arises from using up or assets such as supplies. Still other expenses occurred when the company creates liability, right? So we have revenue 1000, we have expenses 800, so 200 is our income. So what is the loss situation when we have revenue 700, expenses 800, net loss is 100, right? Now here's the big deal, our third learning objective, that is adjust the accounts. So let's explore that. So adjusting the account, which means journal entries made to ensure that revenues and expenses are recognized in the proper accounting period. So adjusting entries are made at the end of the accounting period. So include at least one income statement account and one balance sheet account. It means you are segregating accounts to the statements, that this account belongs to which statement, either income statement or either balance sheet or either both. Let's see that. So we have exhibit 3.3, which gives the unadjusted trial balance. And what is trial balance? Trial balance shows all the accounts and their debit or credit balance, right? Let me just remove this. So at the end of the period, the business reports the financial statements. So this process begins with the trial balance. In that case, here we have Freddy's Auto Service Incorporation, and we have here unadjusted trial balance, right? So the stockholders and management, they need to know how well Freddy's Auto Service Incorporation is performing. So the financial statements reports the information and all accounts must be up to date. So that means some accounts must be adjusted, right? So at the end we have to find out the net loss or net income, and what is the formula for the income statement. So in simple format, that is the revenue minus expenses, we have income, right? So let's move forward to explore this example again. So categories of adjusting entries, one is there are three basic categories. One is deferral. So a deferral is an adjustment for payment of an item or receipt of cash in advance. Right? We'll explore further. Number two is depreciation. And number third is accruals. So let's explore this. What do we mean by deferrals? A deferral is an adjustment for payments of an item or cash receipt in advance. Deferrals are prepaid or unearned revenue. So prepaid revenue means you pay the expense in advance, like the rent. You pay the rent of all the 3 months in advance, right? Unearned revenue, which means you receive the sale amount but you did not deliver the goods or services, right? We call this unearned revenue. Depreciation allocates the cost of the plant asset to expense over the asset's useful life. We have a whole chapter on this one. We will discuss extensive details of calculation of depreciation in that chapter as well. If you don't understand the word depreciation here, just understand that this is basically the cost of using the plant. That's it. How much the plant we have used this year. And what do we mean by accruals? Accruals means it is the opposite of the deferrals. It means for the accrued expenses, the companies record the expense before paying. For accrued revenue, the companies record the revenue before collecting cash. Accruals means that your expense has been incurred but you did not pay them. For example, salaries. The workers have worked for you for a whole month and you did not pay the salaries. That is called accrued expense. Accrued revenue means you deliver the goods and you are expecting the payments near soon, in near future, or customers did not pay yet the amount of the revenue. We call this accrued revenue. Okay, now we will discuss the prepaid expenses in detail. So a prepaid expense is an expense paid in advance. Prepaid expenses are assets because they provide a future benefit for the owner, right? So it means cash payments before expense recorded. So prepaid items, they are either rent, insurance, supplies, advertising. So let's explore this one by one. Prepaid rent, we have example here for Friday's Auto Service Incorporation. Prepays 3 months store rent, which is 3,000 on June 1st. The entry for the prepayment for the 3 months are as follows. What is the entry here? Because when you pay the rent in advance, entry would be prepaid rent to cash, right? And when you want to post the entry, your prepaid rent is debited, so it's on the debit side. You pay the cash decreased, cash was the credit side, so cash is on the credit side, right? And by the way, where this 1000 came from? Because you pay the rent 3000 for 3 months, so 3000 divided by 3, answer is, so 1000 rent is for 1 month.